So we are now going to start off, and what we are going to do is that from the ACCA CB practice platform, there is a question for the sample examination 2. There is this question number 1, which is about the consolidation. So what we are going to do is that we are going to start discussing this question. Let's just start discussing the question. It says that Articut is the parent company of a group whose financial year end is 30th June 2000 X5. The draft consolidated statement of profit or loss contains the number of errors and omissions. These relate to the entities Thadal Company and Findler Company, two investees in which Articut sold shares during the year. Now, the following exhibits available on the left-hand side of the screen provide information so and so, so and so. Now, let's talk about the response options on this question before we go on to do something. So one of the response options on the question is that using exhibit number 1, explain and calculate the accounting treatment in the consolidated financial statement of the disposal of the shares in Thadal Company. So the name of the question is Articut Company. This is Thadal Company. Okay. Can you just go a bit with respect to this exhibit number 1? Can you just read through it so that we could start discussing? Okay. Can you just confirm that when I can proceed? Okay, let's just start off. Now see, it says on 1st October 2004, our ticket sold 50,000 of its equity shares in 𝗘𝗺𝗏𝗀 company for proceeds of $465,000. Our ticket debited cash and credited investment with the proceeds. Okay. Our ticket had acquired 400,000 of the 500,000 shares several years ago. Goodwill was correctly calculated as this and has not been impaired. Fair value of net assets on 1st October were this. On 30th June, 𝗘𝗺𝗏𝗀 sold inventory at a markup of this much to our ticket for this much. Our ticket has still had all of these goods in closing inventory. The sale and the purchase are both recorded correctly in the individual financial statement, but no adjustments have yet been made to the consolidated financials for this transaction. Our ticket valued the non-controlling interest at acquisition at its proportionate share. Our ticket has included 100% of revenue and expenses for the year ended so and so in the draft statement of profit or loss. So on 1st October 2004, you disposed of 50,000 of its equity shares in 𝗘𝗺𝗏𝗀 for this. The question's requirement is using exhibit number 1, explain and calculate the accounting treatment. In the consolidated financial statement. Now see, disposal of 50,000 shares out of the 400,000 that were owned by our ticket company. The remaining number of shares will now be 350,000, which equates to 70% being 350,000 divided by 500,000. The remaining number of shares will now be 350,000, which equates to 70%, that is 350,000 divided by 500,000. Now, the disposal does not result in loss of control, and hence the disposal does not result in loss of control, and hence the gain or loss on disposal shall be recognized within the OCI. Our ticket, sorry, not OCI, within equity. Our ticket would continue to account for 𝗘𝗺𝗏 as subsidiary and will continue to consolidate it in its financial statements and will continue to account for it in its consolidated financial statement. The gain/loss on disposal will be determined as under. The disposal proceeds. How much is the disposal proceed? 465,000. Less net assets that the company had was how much? Fair value of net assets with parent. $4.8 million. We had 80% shareholding earlier, right? Because it was 400,000 share out of the 500,000. Fair value of net assets with the parent was this. The goodwill was this much. So resultingly, what's going to happen is that we're going to say So basically, fair value of net assets that the parent had was this, the goodwill was this. Now what are we gonna do? The disposal proceeds were this for a 10% shareholding disposal, right? Proportion disposed of is gonna be like this. This is divided by 0.8 multiplied by 0.1. So hence, resultingly, what is gonna happen is that this is gonna be this minus this. So this is going to be the loss on disposal. Going to be loss on disposal. Going to be loss on disposal. This is going to be loss on disposal. Now, what will you do? You will actually say the loss on disposal of 23,500 will be recognized within the equity. The non-controlling interest will increase by 488,500. Okay, I'll just explain. Now see, there could be two things that you could do. One of them is like, what happens is that you could say that the fair value of net assets, let's say one of the approach could be like this. You could say fair value of net assets. Okay. Then the goodwill, the proportion disposed of is simply gonna be 10% out of this. So 21,800. That's one way, and this is quite simple as compared to a bit complicated way that I went ahead earlier. I've simply used that. See, this is what we own. We own the fair value of net assets. We own the goodwill. So resultingly, this is what it is going to be. This is what it is going to be. You get my point? Will increase by not by 488,500. You would rather say 486,800. 486,800 is by this. Okay, lovely. Thank you. Now let's move on to the next part of the question. Okay, I'll just zoom out my Kakoto. Okay. Can you do now this question? Okay, you have to actually talk about without calculation, explain the accounting treatment and consolidated of our ticket for each of the following issues. Reversal of impairment of goodwill of Findler, disposal of shares of Findler, and sale of property by RT Cat to Findler. So you have to actually talk about all of them without any calculations. You have to talk about all of these issues without any calculation. So it's like a discursive area that he is giving you. So can you just go through it? Can you just try to see that what should be the answer to this? Yeah, is it done? Okay, lovely. Okay. How many people have done this? Okay, it says the R-Ticket company had acquired 900,000 of the 1 million ordinary shares of Findler company. The carrying amount of identifiable net assets on acquisition was equal to their fair value of 7,950,000. R-Ticket valued the non-controlling interest at acquisition at fair value. This was deemed to be 870,000. So what is he asking? Without the calculations, explain the accounting treatment in the consolidated financial statements of the following issues. Now what next is there? It says on 31st March 2005, R-Ticket sold 500,000 of its equity shares in Findler for a cash of this. This was the fair value of one Findler share. R-Ticket has included the entire proceeds within the investment income in the consolidated statement of profit or loss. The fair value of net assets were so and so. The draft financials includes only 9 months of Findler's profit for the year. And it accrued evenly, plant owned by so and so, so and so, so and so of the carrying amount remaining left. The goodwill of Findler had been impaired by 25% in the year ended so and so. Since the sale proceeds are above the original cost, it was decided to reverse the impairment in the current year, which has been credited to administrative expense in the consolidated P&L. R-Ticket sold a property to Findler for 1.5 million. Proceeds were considered equal to fair value. R-Ticket has included the proceeds in the group revenue. The carrying amount of the property was 1.6 million. Property which had not been derecognized by R-Ticket was used for administrative purposes. Now let's just try to discuss this. First of all, the internally generated goodwill is not allowed to be recognized. The reversal of any impairment loss on the goodwill tantamounts to the recognition of the internally generated goodwill, and it should not be recognized in the SOFP. The reversal of impairment that has been recognized for the goodwill shall be removed from the financial statements, and the goodwill shall continue to be recognized at the amount before the reversal of impairment was recognized. The disposal of shares in Findler will lead to a loss in control of Findler. The resulting impact should be that Findler should not be consolidated after the disposal date. A gain/loss on disposal is to be recognized, is to be determined. The assets, the net assets, goodwill, and the net assets, goodwill, and non-controlling interest shall be derecognized. The disposal proceeds and the existing The disposal proceeds and the existing. No, the reversal of impairment of goodwill is not permitted. The disposal proceeds and the remaining interest in the subsidiary shall be recognized. The sale of the property is not the revenue, and the revenue shall be reversed. Sale of property is rather a disposal of non-current asset, and it should lead to the computation of the gain/loss on disposal. Since the property was carried at 1.6 million and it was sold at 1.5 million, which was also the fair value of the property, the sale at 1.5 million is an indicator that the value of the property has reduced and that an impairment loss of 0.1 million shall be recognized. Additionally, the property should be removed from the books of RT-CAT and be recognized in the books of Findler. I'm not saying continue to recognize. I'm saying continue to be recognized at the amount before the reversal of impairment was recognized. I'm not saying that it should be recognized at the original amount. Okay, I'll just zoom out. Can you people just see this, please? Okay, now let's move a bit forward and let's talk about the last aspect, which is using the pre-populated spreadsheet. Using the pre-populated spreadsheet, um, response option, revise the draft consolidated profit or loss for the year ended so and so, so and so, ignore taxable implication, calculation of the profit attributable to non-controlling interest is not recognized. Now, um, okay, can you just read through this and can you just let me know that what is gonna, in fact, did we miss out this? Or is it the same? It's the same, right? Delete page, where do I delete page? Okay, can you just read through it and can you just let me know what is gonna be the impact in the P&L on this? Yeah, can you identify the adjustments, please? Okay, see, we have to do it in the P&L. So let's just see that this one at 30th June 2005, Thadal company sold inventory at a markup of 25% to our ticket for 30,000. Our ticket still had all these goods in closing inventory. Now see what happens is that the adjustments that need to be done. The adjustment that need to be done. Number one, intra-group sale of Intragroup sale of 30,000 to be removed from sales and cost of sales. The unrealized profit is 30,000 divided by 100 multiplied by 25. Added to cost of sales. Right? What else is there? First July 2002, right? 1st October 2002. 1st October 4, 30th June 5. Consolidate till 31st March. Mhm. Record as associate post acquisition. Recognize share of income from associate for the last 3 months. Um, Reversal of impairment. Rectify the reversal of impairment loss. It's actually gonna be how much? 1020,000 into 25%. Then what else needs to be done? Um, Revenue to be reduced by the sale of NCA 1.6 million. Impairment loss on the asset to be recognized. $0.1 million, right? So this is probably what you're gonna do. Yeah, is that okay now? Is that okay now? Okay, so what you need to do is that you need to incorporate these adjustments to the financial statements. So when you would be preparing this consolidated financial statements, these are the adjustments that you would be doing to them. You would be removing this 30,000 from both sales and cost of sales. You would be adding up this 7,500 to the cost of sales. Then what happens is that the impairment loss needs to be removed from the administrative expenses. I mean, what you have done is that you have actually reduced the administrative expenses. So you would increase the administrative expenses. The revenue needs to be reduced, and this impairment loss needs to be recognized for the administrative expenses. That's how you will do it. So the adjustments that you have to do are going to be like this. Yes, we have to remove the unrealized profit in either case, whether it's a subsidiary selling or it's a parent selling. Everyone's case, you have to remove it. Right? Okay. So we are done with this. Let's meet up now tomorrow, where I'm gonna continue now. I'm gonna start doing the questions from the revision kit. They will be mainly the question number 2 and the question number 3. That's what we will be doing tomorrow.